Good morning, friends. We are with another episode of NK's Lockdown Musings. This time, I'm going to take you on a different journey, a journey into the stock market. Now, most of us have been sitting at home, twiddling our thumbs or using the thumbs to do some good work. But many of us have indulged ourselves in the stock market in the past. And during this phase where the COVID 19 has struck, the stock market has lost about 30% in its market cap. Now, this has affected a lot of small investors. Obviously, the big investors will not be that much affected, but the small investors definitely will be affected. To discuss this with me today is Naveen Fernandes. Now, he's a certified financial planner, just one of 2,000 in India. He also teaches at Christ College and St. Joseph's College in Bangalore. In fact, he is joining me from Bangalore. And he is also a former portfolio manager. Now, he has got about 30 years of experience, just about the amount of fall in the stock market, right? So he probably can throw some light on what has actually happened to the stock market, what will happen to the stock market, and what do you do as an investor. Naveen, can I just begin by asking you, what has happened to the stock market? I think everybody is concerned about that. It's fallen by about 30%, if I'm not mistaken.
30% and a little more. Good morning, Brian, and hi, folks. I'd like to take this in two parts, actually. The first is whether the COVID itself is the reason for the market's fall. The other is what impact COVID-19 will have on the market. For one, I think as in previous crashes in the Indian or even global markets, the markets needed an excuse rather than a reason to fall. The markets were overheated. The Indian markets were extremely expensive, close to being in cuckoo land for about 2.5 years. And this is simply an excuse that triggered the fall. In 2008, we had Shanghai followed by the subprime and bear stearns, which triggered it. The problem existed. So in India, if you look at the Indian markets now, the trigger was COVID. The reason was extremely expensive valuations in the market. First, the second part is that this virus, the coronavirus and its global implications have accelerated the fall. We've fallen about 30%. We need to look at the previous peaks in the Indian market and the crash since then. Let's look at 1992, 94, 2000, 2008. All these, the markets fell about 65% from their peak. In valuation terms, I do not talk of index numbers, but index valuations, the markets were in this very expensive zone for more than 2 years. And we've just seen, in my opinion, just half the fall in the index. How much more will the markets fall? I think there we are in uncharted territory. Besides the 65% where the market could mimic previous falls, the unprecedented impact of COVID, I think, could push us to lower levels. The last major global impact of this kind would be the Black Plague in Europe, where about a third of the population died, and it created a socio and economic change in the entire environment. Will that happen with us now? Possibly. I wouldn't like to bet otherwise. Right.
Yeah. I do understand that the markets have fallen and the COVID is not the reason, is what you're saying. But the fact of the matter is that the COVID-19 epidemic as it has happened and the lockdowns that have happened thereafter are going to shut a lot of businesses. or they are going to take a long time to revive. There is another issue. The crude oil prices have dropped because the production has gone up substantially by Saudi Arabia because they could not reach an agreement with Russia. There is no place to store the crude oil. There's a glut in the market because there is no consumption because of the stop in the production by the COVID-19 lockdown. So these are effects that are going to last for some time. Am I right?
Yeah, absolutely.
Okay, so once the effects continue to last, the stock market revival is very difficult to say. As you said, 30% is not the end of it. It could go down further. Am I correct?
Yes, the first part is that the anticipated fall in line with previous falls would give us another 35% downside from here. First, the other is that the lockdowns, and if you've read the 31st March report by Howard Marks a couple of days ago, Hussman, they've taken a lot of data and expectations that unemployment would be extremely high. As it is, the US unemployment data for last week was extremely high. On a worst case, it is expected that the US unemployment would go up to beyond 20%. We could see something worse than that in India, with industries, businesses shutting down, with migrant labor not being able to come back. And this would mean that bankruptcies, which would of course lead to bank non-productive assets, bank losses, the inability of people to consume because they have no income. All this is likely to multiply, and therefore it is quite possible that the market could lose more than 65% of previous falls. At the same time, again, looking at the Howard Marks report of March 31st, he mentioned research where talked of a drop in profits in corporate earnings. Let me just go back to 2007-8. Expectation for the Sensex earnings in 2008 were about 860 rupees. In January, we saw the crash and the earnings ended up at about 750, about 15% lower. Now, the possibility for the US is that the earnings would drop by as much as possibly 120%. That means 100 rupees profit would translate into 20 rupees losses going forward. That is going to tell in the stock market numbers, corporate results, and translated to corporate prices, stock prices. At the same time, I mentioned that I've been expecting this for more than 2 years. I have moved substantially into the bond market, and I see risk there as well. I don't see the fixed income market being safe, except that I feel it is relatively a lot safer than the equity market at this time.
Okay.
At this moment, like in any crash, cash is king. And if you have the money to buy when things are bad, 1929, we had Joseph Kennedy who said, when there is blood on the streets, buy. He had cash to buy. I think having cash now would make people kings for a long, long time. I just don't think it's time to buy today or this week. But I think it's good to keep cash and prepare a shopping list of your dream stocks and buy them. But the dream stocks of tomorrow might not be the dream stocks of yesterday.
Yeah, I think the economy is going to change. Of course, in the current situation, I think the pharma industry, the food industry, the mask industry, the ventilator industry, that's the one that's prospering. Those who can prepare those or manufacture those, they are prospering. But after the COVID-19 lockdown is lifted and COVID-19 disappears, which is now it's $1 million question, how it's going to disappear, because there's no vaccine, there's no way of stopping the transmission unless you separate yourselves from others. And how long can you separate yourself from others without having the effect on yourself and on the economy and everybody else? So these are all imponderables that we have to deal with. Now, given that there are small investors who have invested in mutual funds via, via SIPs and via SIPs and small stock buying. So I'm sure they're going to be impacted a lot. What should they do? Should they stay invested with the SIPs? Should they change the SIPs? Should they stop the SIPs? Should they keep buying stocks in small quantities? Should they sell off? That's what I want to ask you.
Okay, this is a very dicey question, tough to answer. Look at it this way. We've been talking about SIPs for a long time. I do not believe that a lot of the old supposed wisdom that we've inherited from our great-grandparents makes sense. For one, we are taught that equities are good for the long term. I think that is a truckload of garbage. We keep hearing about Warren Buffett saying my holding period is forever. A little bit of study of Warren Buffett suggests that his holding period is 18 months, not forever. He has been selling. Yesterday, I saw a tweet by Morgan Housel where he mentioned Warren Buffett. He says holding period is till the pandemic starts. Warren Buffett has been selling. Now, markets go up and down. And if you've seen the index since the last 28 years, 1992, the markets have gone up and down. And the only time the markets really performed well over a long period of time was 2002-3 to 2007-8, where in 5 years, the market went up 700%. I'm talking of the index. Otherwise, the indices have been very poor performers. One. A study I saw about 10, 15 years ago said that equity SIPs over the last 5 years, and 5 years is long term, are negative. You lost money. The important thing is for people to avoid the classic investor or even advisor problem of greed and fear. We will buy when the markets are up. We will not buy when the markets are down. And today we have occasionally the markets going up, which I believe is what's called a dead cat bounce. It's a little breather where the market goes up a little bit before falling again. And this also tempts people in. I'm okay with someone who has 90% in cash. He can start biting. But for anyone else, I would say, just wet your lips, maybe start sipping very, very, very small. Maybe invest 1% of your money in installments and keep some money aside for 3-6 months down the line where you can make bigger purchases. Picking stocks for the future, I can't claim to be good at this, but let's say you're in Bangalore. There's this guy in Bangalore, Prabhakar Kudwa of Samviti Capital. I found that he is able to work well in picking good stocks. I have a good friend and former neighbor, Kenneth Andrade in Bombay of Old Bridge. These guys have the ability to find moats and do things differently from the crowd. And I think being able to do that would make a difference. But for the investor, I would say hang on to your cash. If you can raise more cash, sell your junk. And I think junk should be sold at any time, even if you're taking a loss. Take a loss today because you probably make a bigger loss tomorrow. What's going to be the stocks of the future or the industries of the future? I don't know. I don't think it's going to be hotels. It's not going to be aviation, not real estate, not automobiles, but could be pharma, could be retail. I really don't know. I mentioned a couple of experts who I trust, and they're possibly better equipped. I don't think that mutual funds are a solution. I think it is for us to advise our clients when to get into and get out of certain mutual funds and pick the right kind of investment asset class,
Okay.
whether you should look at equity or debt. I looked very foolish when I told my friends and my wife 2.5 years ago, let's stop our SIPs and start moving out of equity. I looked very stupid for a while. I was talking to my doctor a couple of weeks ago. He was asking me why I'm so jolly. I'm happy because I looked foolish for a while and looking stupidly happy today.
Um, Keep talking. I'm diagnosing you.
I can't afford a COVID test.
Yeah, I was just wondering, you diagnosed the economy very well. We'll just take a short break now and we'll come back shortly. Thank you.
Okay.
Yeah, so after this short break, Naveen, I just want to take you on to the effects of the lockdown on the economy in India. Now, as you know, the unemployment rate was about 6.7% as per the government's own data, just in the last quarter. And with the COVID-19 epidemic, the lockdown and the migrant labor going back to its home states wherever it's possible, many of them are stranded wherever they are. Uh, Getting back on track, both the economy and the migrant labor, getting them back on track in their employments, I think that's going to take some time. Am I right?
It's going to take a lot of effort, as it is various analysis of GDP. The government numbers are one, but the numbers that various analysts have given out globally look at extremely poor, around 2%, even negative. Wall Street Journal, I think, said that India is actually having negative GDP growth. Combine that with unemployment, the difficulty of quickly getting back onto our feet is going to be a challenge. Um, I do not know how much the fiscal um, liberty, the quantitative easing, not just in India and globally, is going to help. It's going to make assets costlier. It's going to hurt the retired people. But at the same time, at this time, I think people who are losing jobs will have a problem just eating. These retired people would have some money set aside, and that would help them uh, survive. I do not know how people with loans, no jobs, newly married, EMIs on their home, EMIs maybe on their car, I don't know how they will survive. The moratorium that the RBI has asked banks to offer, I think is a bad idea for people to take up, because it means that their interest burden will go up. 3 months later, you'd be paying 6 months of installments. And this would put pressure on the person, it would put pressure on the banks. If a young person defaults, it would possibly mean that they will not be able to take a loan for the rest of their life because they would be a bank defaulter and their credit score would be rotten. Now, all these are problems that individuals will have to face. As as an economy, I think the getting migrant workers back to work, um, maybe giving a tax holiday, GST, and whatever else would be some kind of support. But I really don't have that solution.
I,
It's going to
I,
be tough.
I think a moratorium is not such a good idea. I think a little bit of a waiver would have been good because obviously, as you said, a moratorium means you have to pay back more afterwards, and most people will be just getting back on their feet, getting back to their jobs, maybe with half salary, maybe with three-fourths salary. We don't know because companies also will find it difficult to pay. I just read a news item in the Gulf that the government has allowed private businesses to slash salaries by 50%, up to 50%, and officially. So that's going to happen in India also. And when people start to get back on their feet with about 50% salary or 75% salary, where are they going to pay their EMIs from? And then also the higher, the additional installments. So these are all very big challenges. That's just one part of it. The migrant part of the workforce is around 37%. And they are mostly paid on a weekly basis or a daily basis. We don't know. But they are the hardest hit. They are neither able to get work in their hometowns, nor will they be able to get back to work in their cities. And I think that's the greatest challenge. Now, the GDP was around 4.7% before the COVID started. It's likely to drop, as you said. And the rest of 2020, unless we find a vaccine fast or we find a way to get rid of COVID very quickly, is going to be quite difficult. With this is just the negative side of things. But there has to be a silver lining in the cloud. Do you see any silver lining?
I mentioned the Black Plague. That
Sorry?
helped the Black Plague of Europe.
Yeah.
1600s. That helped the marginal worker. In fact, if you see the classical economists, they always considered labor to be paid sustenance wages. All of a sudden, these guys were in demand because the population was smaller, and that created a middle class. Whether that will repeat it now, I don't know. But for one, we would have a seriously low base on which to build. This is an opportunity for the government to build infrastructure. And I'm not talking about power, I'm talking of infrastructure in education and transport, in medical services, maybe a greater link to the agricultural producing areas with the consumer. I think these are opportunities which this lockdown has given us.
Okay. I think we'll come to a conclusion that there is always a silver lining in every cloud and in every COVID, if I can put it that way. We have to look for the silver linings. Otherwise, we'll be desperate and we'll despair. And we should not. We have to stay locked down until we have to. We have to enjoy our conversations like we did today. And with these conversations, we can inject positivity in the society. That's the purpose. Now, viewers, I just want to conclude by saying that this was a lockdown conversation. Obviously, we were talking from our homes, and you'll find the dog barking in between and a fly moving across the camera. Now, these are all part and parcel of life, and we cannot wish them away. And just to hear the dog bark is such a pleasure. We don't hear the vehicle sounds, but we listen to the animals bark or shout their woes out and the birds chirping. And that's a great positive sign. So with that, we conclude. Thank you very much, Naveen, for joining me. And we'll do another episode of Lockdown Musings shortly. Thank you very much.
Thank you, Brian. I believe there's money to be made. I wish all viewers a very prosperous time. It'll come soon.
Thank you. Thank you. Right.